Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, October 18th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right. Well, we had another week of, I guess I'd call it extreme volatility last week. We had the major averages all over the board. They ended up mixed. As we kind of bounced around after getting some hotter than expected inflation reports on the September PPI and the CPI. That probably has locked in a 3/4 of a point rate hike in November, on the November 2nd, 3rd FOMC meeting. Right now, I think the CME group, FedWatch, is projected about a 98% probability of a 3/4 point hike. That's about as much of a lock as you're probably going to get. Anyway, we started out, we tried to bounce, to start the week out, but we did see some selling technology shares after the U.S. imposed some more restrictions on China's access to semiconductors. On Monday, the Philadelphia Semiconductor Index alone was down almost 3.5%. That was a new one-year low, and we saw Nvidia, Advanced Micro, Lam Research, all of them pretty much dumped on the week. I think for the whole week, the semiconductor index was down 8.2%. I think the week before it was down about 6% or so. So it's off about 15% here just in another like 2 weeks. Now we saw equities move lower again on Tuesday. Part of that was recession fears keep growing as China keeps locking down different cities. Now they're locking down parts of Shanghai. They want that zero policy. As they do that kind of slows their projection for growth. It also stokes recession fears, and of course, with recession fears, you're going to see crude oil prices and demand go lower. We saw that crude oil slipped below $90 a barrel, I think, on Tuesday. That's despite OPEC the previous week saying that they were going to cut production by about 2 million barrels a day. And I mentioned in one of my letters that although that's more than 1 million of that is Russian oil, so it's not as bad as it seems. It's not that the administration is saying that it's all all bad and we're getting shut out by anybody. But anyway, I think oil slipped all the way down to about $85 or so after that. And again, it's on demand concerns with OPEC. Okay, then we got the PPI on Wednesday. That was much hotter than expected. Again, we saw a little bit of bounce up on Tuesday and it sold off at the end. That's just traders hoping to front run the first time we see the inflation numbers go from say 8% year over year down to maybe 6%. They're going to be all over that when it happens. But that didn't happen on Wednesday. In fact, I believe I forget what the Dow was down, but it was down sharply all day long. So was the NASDAQ. We came in for the CPI after with the S&P 500 and the Dow being down about 6 days in a row. And a funny thing happened. We got the CPI. It was above expectations, but then we opened up sharply lower at the bell. But we kind of ran into basically, well, a lot of it was where our price targets were on the S&P 500. Our price target was 3,900 to, 3,390 to 3,400. We got right down to 3,394, I believe, and then we bounced off of that. And as we started to go higher, we got a short cover rally, and that really just fed on itself. And we saw the Dow spike about 827 points. That was almost 2.8%. And then the NASDAQ was up about 2.25%. We had big moves in the financials and energy sectors. A lot of people were hoping that was a capitulation bottom. I don't think it was, but it may have marked probably a bottom for this little term segment here. Then we started to follow through with it on Friday. We moved higher, and then somewhere around there, yields started to move higher again, and the 10-year crossed above 4%, which has been a troublesome area ever since June. And then we saw the 2-year cross above 4.5%. It closed the week at 4.51%. That strengthened the dollar. Of course, when the dollar gets stronger, that weighs on commodities. That also weighed on oil prices. Oil prices actually were down, I think, about 8% on the week. They settled at about 85.78. The Dow, because of that big move on Thursday, was able to squeeze out a gain for the week, but the rest of the indexes were mainly lower. We did see strength in consumer staples, healthcare, and the financials. They managed to post positive for the period, but consumer, kind of the growth sectors, consumer discretionary, technology, they were the weakest. And then, of course, your rate-sensitive group, utilities and REITs, as rates keep moving higher, they're gonna be weaker. Part of that reason is historically these utilities have traded at around about a 8 PE. They're somewhere up around 14, 15 right now. So they're very expensive as rates keep moving up. It's one of the things we'll look at later on here that I will show you. You probably don't want to be looking at those for yield or anything at this stage. So, like I said, while the Dow Jones is able to hold on to some of Thursday's gains, closed higher, the S&P 500 and NASDAQ were down for second week. Now, the technical condition of the market, I said it was mixed last week. It kind of went nowhere as far as the different indexes go. The Dow Jones did outperform the broader market. When the other indexes underperformed the Dow, that's what weighs on the momentum index that you'll see on the market letter. That fell to a -10 from -8 the previous week. The technical indicators for the Dow had kind of nudged up into neutral territory, but they're still weak for the S&P 500 and NASDAQ and for most of the other indexes. We did finish the week oversold. I know the MarketEdge S&P oscillator was ended the margin at about 372. That's not real oversold, but it's considered quote oversold. We like to see it get above around -7 or so when we really start to see the institutional players come in. But on Thursday when we had the big on the morning drop, we saw the S&P 500 hit our downside target, and that was we were looking for it to retrace 50% of the rally from the March 2020 lows, the January 2022 high, and that was 3,500 was our S&P target, and we traded down to 3,491. So that looks good to us. I'd like to see if we want to make sure that holds. If that doesn't hold, which would be last Thursday's low, then we're probably going to be in more trouble. We could see a target of 3,400, 3,405, something like that. Now, the NASDAQ had previously retraced more than 50% of its rally, and it broke support at 61.8, and we had our target of that at 10,300, and it traded below our target. It went down to 10,268. So again, we were pretty close on our projections and our targets. I'm happy with that. We're within a couple points of each of them. But if that would break the 10,268, which was the low Thursday morning, then we could see the NASDAQ maybe tumble down to about 10,000. I don't think that's going to happen in here anytime soon right now. The Dow has outperformed. We had our targets at 27,940, followed by the 50% retracement level at 27,580, 27,6, and we didn't get down to that. But we got down into 28,000s, but we're okay with that right now. Underlying breadth remains weak. We had the NYSE and the NASDAQ advanced decline lines, and we consider those kind of leading indicators of market direction. They continue to work lower. They made new lows for the year on Thursday of last week. We had the new 52-week lows continue to outpace the new highs. We had more than 900 new lows on Thursday on both the NYSE and the NASDAQ, so that was tough. We also saw the sentiment index fall back down to what you might call a irrational exuberance to the upside. I'm not sure what you call it to the downside, but extreme bearishness came in again. The retail investors are down to around 20% bullish. And on the National Association of Active Investment Managers Exposure Index, we had climbed up to 38.1% exposure to equities going into last week's numbers and all that. We ended up the week at 19.8. So they sold on that inflation data, and we'll have to see, if they start to pick it up again this week. We could see the institutions probably move in a little bit more. I think there's kind of a feeling that we're, when you get near a bottom, volatility picks up, same as it does at the top. A lot of times you'll start to see some big swings as some are looking for a breakout further to the downside, while some are looking for these big swings to hold and then mark it up. So I don't think we didn't really have a textbook selling climax, which a lot of times you'll look for in a bear market. But I do think that we came, we put in probably a downside goal or support level here, over the short term. I think we could probably see a little bit of a bounce around in here, and then, for a couple of weeks, and then we'll start to maybe fade this as we start probably getting more. If we start getting inflation data again in November, that's not going to be good. Now, yesterday we had a nice rally to start the week. And of course, we got the Dow back up over 30,000. Part of that was, good earnings from Bank of America, Bank of New York Mellon. The banks have been doing well here, like we talked about. I guess it was last week. The investment banking side is going to be low. It's going to probably miss, but when you're paying out when you're 1% and then getting 5 or 6% on your investments, your net interest income was going to be carry the banks. And it's certainly doing that right now. So again, what was it? Goldman Sachs today, they came out with some strong earnings, and somebody else, I can't remember who else it was today. But anyway, that was strong. We had a little bit of weaker manufacturing data yesterday with the Empire State Manufacturing Index. It fell down to minus 9.1 from minus 1.1 the previous month. And then we had a reversal in England of their economic plan that kind of sank the British pound and kind of rattled investors, global markets actually, for about a week there. I think they may have been on the right plan, but they didn't like it over there, and they're going to reverse that. But anyway, we saw gains across the board. We had that again today. We opened up over about 600 points this morning. We have seen that almost. They were cut in half for a while. They're kind of bouncing back here in the afternoon again. The breadth looks strong despite some of the indexes struggling a little bit. But with that manufacturing data pulling back a little bit, you did see the some of the yields inch lower yesterday. Not much. You had, I think it was people were looking for a 0.75 of a point hike in December. And you saw that go from about a 69% probability down to about a 60% yesterday. So that was good. I think the market would like to see the Federal Reserve only hike a 0.5 point or maybe even less in December. We'll have to see how that goes. But I said yesterday that if we see the Dow break above 30,500, I think you could see another short cover rally that could send the Dow up to its 50-day moving average. That would be about 31.3. I think we got today up to around 30,800. So we're coming back down here where you kind of saw that little breakout level around 30,500. We got down to that area, just a little bit below that. And now we're starting to move back above that, which is a positive. And it's one of the reasons I think that we may see as we go into the earnings here, we may start to see a little bit of a move. So we've had these these what they call bear market bounces. We've had several of those this year so far, and we're probably going to have another one. And I think this one may have maybe a little bit more oomph as we go into earnings.
Okay, so you see this as an oversold bounce, but you think that it might have a little more in the tank than some of the previous rallies. What makes you think that this bounce could be stronger than the others we've seen here?
Well, I think we're kind of setting up. We're down. The NASDAQ's still down, 34%. The S&P 500 is down around 28%, something like that. And we've been down all year long, basically. NASDAQ's coming up on a year since it topped out. And what I've been looking at are some of the different sectors. I'm starting to see some positive signs in the different charts. We look at the regular bar charts and candlestick charts, but we also have on MarketEdge point and figure charts. And I think that if we can go over a couple of these, you should be able to see what I'm talking about. I'm going to show you where I think we can see some resistance levels coming in on this. We'll just go right down the line. Let's start out with XLC. And we can go to that. We'll go to the the second opinion. Okay, let me get my stuff up here real quick so I can look at the same stuff as you are. Okay, XLC is a communication services sector, and what we like, what's included in this, Meta is in this. We also see Alphabet. They're the two biggest stocks in that. Then you have some of your other social media type stocks bouncing around. We have an avoid on XLC, but if you look at the chart over here on the second opinion page, you're going to see that we have a pivot area somewhere around 50-60 on this thing. Let me get something else over here real quick. Sorry, Will. Okay, so we have this thing. We came up on the XLC with today's bounce. We almost got up to that high that we saw around October 3rd or whatever it is. Back there, we had that little gap up, and you kind of kept gap down a couple of days later. So that would be our first point of resistance, which is going to today we hit that around 50-60, which is right where that October high came in. So that's going to show you the first point of resistance on this. Now go ahead and click on the point and figure chart for the same thing. Okay, and we're still in a series of negative X's on this, but when you look at this, we'll get the three-box reversal on this. If we can get above 53, this is going to just be considered an oversold bounce. But once we get over 53, then you're going to get a series of X's coming on here, and that should take you back up close, right about where the 52 or the 50-day moving average is. Then you get above through there. You get to about 54.60 with the 100-day moving average. I think you're going to get up into that area, and as you can see on the point and figure chart, and again, I'm going to need to look at that also. When you get to the point and figure chart, you're going to have resistance up here around 54. That's where those zeros go across on the bottom. After you, right above about 53, 54 will be a little bit of resistance. If we can, we'll probably get into kind of a trading range at that point, where you have probably to the upside. Maybe you get to 61, where you got somewhere in August, and then kind of go a little bit sideways. That doesn't look real strong, but I think once we get the reversal with the X's going up, that we'll start to see a little bit more strength in that. Go ahead and click on the XLY. This is another growth sector. This will be your consumer discretionary. And as you can see here, we're already on the chart. We need to get to about 150.50 to get to the October highs. We've had a strong bounce here. That's why we're in a series of X's. This is to get a X. All you have to do is the next X would be across 144. Would give you your next X. That would take you up to 146. But we're getting close here. We're getting close to the 100-day moving average, and that's going to come in at 151.78. All right. If we can get to that, I think that's probably going to start to give us a little bit of trouble on this thing. But at this stage, we are actually in an uptrend. We sold off a little bit today, and we bounced up to 145. We haven't quite made it up to the October high. So we've got a little bit more upside, but it's the 100-day moving average is up here around 150, 180. I think we could get a little bit more strength. We have a crossover in the MACD today. We also have some strength in the RSI. The RSIs on all these are heading up. Remember, we've talked a lot. We'd like to see the RSIs get above 60 to ring the bell that says we're probably in an uptrend. If we can get above resistance up here at 150, at that stage you're going to get a double top breakout on the point and figure chart. Are you on that? Let me see where you're at here. Okay, yeah. On the you get above 150. We get a print above like 150.20 or whatever. That's going to give you another a breakout at 150 in the double top, which leaves the door open for a pretty good run as far as I can see. Maybe up to 155, 158 area. That would be where we had a grain of resistance before, back in June and July. So that gives you a little bit more upside. That's getting closer actually there to that would get you running the resistance somewhere around the 50-day moving average. So I think again that's showing some positive signs here with the technicals going positive. We might be able to see a little bit more bounce in that. We want to see today's opening bounce turn around a little bit. But you came down, you gapped up, you kind of filled this little gap that we had today, and you're starting to move back up. Okay, let's go to XLP. This is the consumer staples. This is especially in a recessionary type of environment, you should do pretty well. I mean, everyone's going to keep using paper towels and toilet paper and going getting their toothpaste and soaps and food, that type of stuff. So this is normally in a slow down. This sector should do well. On the regular chart, you can see we crossed above the October highs already on this today. You can't see it on this, I guess you can't see it, but we got up to 69.50 at the high today. That's where the 30-day moving average comes in. This is the pivot point on this is 69.15. The 50-day is up here around 71.50. So the fact that we were able to clear the October high today is a bonus. We're getting ready to cross the 50 line on the 14-day RSI. That's a positive, and we're also positive on the MACD. We've already gone positive on that too. So this is one that looks like it's in the process of breaking out. I think tomorrow we'll see. We need to get a print above 70. We won't get the reversal yet on the point and figure chart, but once we get a trade above 70, then we'll get the reversal on the point and figure chart, and that'll take us up there where I think we can probably, next resistance is, well, resistance is going to be 70, but if we get above that, then we can probably work our way back up into the 73, 74 area before we see some real trouble on that, which would be up close to the 200-day moving average. Okay, let's go to XLE. Remember, I think it was last week I said if we're going to be long one section of the market, I still like the energy stocks. And then we had about a 4 or 5 day, a real nice rip on these things. If you look at that right now, the second opinion is long on XLE, so it's considered a buy in here. Let's see, we're trying to break above 84, which is actually above the. If you look at that going back into August, we ran into resistance up here at 84 several times. 1, 2, 3, about 4 or 5 times. If we can get a print above 84, that's going to give us a double top breakout. And there's one thing I did want to touch on base with this. When you have, go ahead and go to the point and figure chart. And you can see right now we have this the 2 X's across here at the at 83. Let's give 83 to 85. So 84. This shows that your resistance. If we were to get a print of $84.10 or even 2 cents, we're going to get another X in there, and that will mean that we've gotten our double top breakout for energy. Now, one of the things, if you look at this thing going across, and you go to that long string of X's, 1, 2, 3, 4, 5, 6, 7, 8, 9 boxes over. We'll count that from the right side of the chart over to the next long string of X's going up. That there. Okay. Now, if you start with that and start counting over, go 1, 2, 3, 4, 5, 6, 7, 8. Okay, we have 8 columns in there. And point and figure charters, what they will do is they look at this as congestion. And when you get something with congestion in here, if you take where the breakout comes, you add that to where the breakout is, a lot of times you can, that'll be a target. Now, in this case, I would say, since we had the long string of zeros, 1, 2, probably only, I wouldn't, a lot of them aren't going to count that as 8 bars of congestion. They may just count it as 3 because we had the long string of zeros. If you count the 3, that's going to give you 84, 85. That's going to give you a target of 86, which is exactly where the other string of highs went, which means we've got more upside on this, and that's just a little trick there. So, you take the 3, add to this 84, say 83, 84, 85, 86, and you get the same target as we had before. So that's a bullish chart on the S&P thing. We are getting our breakout in here, and I think that's an area you can still hold on to if you're not buying. Okay, the next one we want to look at is XLF. And this is the financial sector. And again, this is looking good to me right here. We've had some, we've had some strong earnings last week and today. We actually this morning we gapped up above the October high there. As you can see, we actually got up to 33, I believe. Not quite 33. We got up to 32.66. So that's above the October high. That's bullish. The 50 and 100-day moving average is where we actually got to today, which is coming in right around 32.70, something around there. We hit that and bounced back off of that. If we can break through that, we actually could probably see another breakout up to probably around the 34, 35 area, which is where the 200-day moving average would come in. The 14-day RSI is at 54. Again, if we could see that and get above 60, 65 or so, that would be a big plus for that. Go to the point and figure chart on this one. Okay, we printed today. We got 32. The high was 32.66. If we can get back to 36, which, well, I don't think we're going to get that. That may be about as high as we're going to get. If we get for 30, we got a 33 print today, so we're going to get a series of X's coming up. But you're going to run into resistance up here around this 33 area, and you're going to have a sloping downtrend where you can draw in off of the row of greens, the second row over to the top of the red circles there, the first row, the first column. You can actually draw trend lines on these point and figure charts, and that trend line is going to give you a resistance line of between 33 and 34, which is just above where we were today. But you had the potential possibly to get up to 36 here if the whole market can keep pushing along. That would be I see the strength in the financials as one of the areas where we're going to they're going to lead the market in here as rates keep going higher. Part of the problem is you get in a recession. It's not the best place you want to be, but until we actually are determined that we are into a recession, I think you can probably see the banks move a little bit higher on there. Okay, another one that I kind of like that shows, it gives me a little bit more positive feel for the market, XLV, which is the healthcare sector. Okay, today on the open, XLV gapped up to the highs of October. Again, that's a big plus for us. We got above that briefly. We came back above it. Now we're starting to move back. We actually also got above the 50 and 100-day moving average on this chart right now, and we sold off back down to the 50. We're still above that right now. If we can stay above 127.40, we'll actually close the day above the 100-day moving average, which would be a real plus. So that's a good sign. Next resistance after we get above that would be around the 131 area. If you go ahead and go to the point and figure chart. Okay, as you can see here, this has been going sideways in here. You got a sloping downtrend line from where you see that 8 going down to the next X. Would give you some resistance around 130. That is also where the 200-day moving average is. I imagine we're going to go up at least test that. Yeah, it had a little bit of weakness today with Johnson & Johnson's earnings. They were good, but the stock didn't do much on the earnings. But the technical indicators look good on this. Everything looks positive. Everything's on the rise. I think this is going to be one of the leaders that also will help. Maybe help us turn this little bounce into a 2 or 3 week up move in the broader market. Okay, last one I want to check in on is XLI. This is the industrials. And again, this one's a fairly, it's just showing some signs that we've got a good thing in here. We've got a double bottom on the regular chart, as you can see there from last Thursday, and then previously the last week of September. So that double bottom looks like it's going to hold. Today we actually gapped up above the October high, not by much, but we did get up above it. We got up as high as 88.90, 91. That's a positive. The 100-day moving average is up here around 90. The indicators are positive on that. If you go to the point and figure chart, okay, if we get a print above 89, will get us a double top breakout. That's another positive sign. The double top breakout then would take us up into the low 90s, where we'll struggle with the 50 100-day moving average. If we can get above that, then maybe your upside could be around 94.50, where the 200-day moving average comes in. And then again, you can also see that right around 92 or 90. Let's see, around 92 or so up there is where we kind of found support briefly on the X's and O's back in September. So that gives me a little bit of hope also. The gap up today, you filled that gap after we gapped up, sold off, and then we're heading back up again. Now we're starting to move almost positive on this sector too. Gives me a little bit of hope that we can see some leadership in this group too. The indicators look strong. The only 2 sectors here that we didn't cover. Let's go over XLK. My fault. Go ahead and click on XLK. I'm trying to hurry as fast as I can so we don't take up too much of your time. XLK, again, we had that big bottom there at the bottom last Thursday where we sold off. A lot of that weakness was from semiconductors, obviously. And then we opened up today. We opened sharply higher today, but we've given back almost all of that. And again, what's bringing it back, the technology sector down today again, is the semiconductors. They're just not looking too good. Because we had that big bounce off of Thursday's low, we are in a series of X's, but we're going to have to take, 122, 18, 20. If we trade around the below 119, it'll turn back into a series of O's on the chart. Go ahead and go to the point and figure on that. Okay, you can see that. So we're in the X's right now. It takes a 3-box reversal, so we get into that. We need to trade below 119, I guess 119.50 actually to reverse that into O's again. But this thing needs to get up at least to the October highs, and that's going to be around 127.50. And we're only at 127 right now. We opened the day up around 123.90, almost 124, and it hasn't been able to hold. And again, the reason is the semiconductors are down today. Almost every other sector is higher. The semis are off right now. They're off about 0.5%, and that's weighing on this whole on the whole technology sector. I think we need to see a bottom come in here on the semiconductors before we're going to see this thing contribute, and the market needs to see these big cap tech stocks kind of roar back here before we're going to get, but before it's going to be more considered more than just a bounce in the bear market. So that's when you're going to need to keep on. Go ahead. We'll go to the SOX, the Semiconductor Index, real quick, and I'll wrap it up after this. Okay. Now, if you look at this thing here, we made that thing Thursday. Today we opened up right at 2,300, which is where 2296, and that is where the high was on the regular chart, the bar chart. That's where the high was on Thursday and Friday of last week, and we got there again today. So this 2,300 it's not breaking through. We're still negative on the MACD. The RSI is down here around 35. That's the weight on the technology sector, and until we can maybe see this thing bottom, maybe we put in a double bottom at around this 2,100. I don't know, but we do need to see this thing firm up and find a bottom before we're going to see the technology sector help us. So until we see that, I think we should consider what we have here as a bounce in a bear market. But like I said, I do think we're going to see, because of the strength in energy and healthcare and materials and financials and even the consumer staples, I think that we can see this thing get a little bit more to the upside before we start to things get rattled up. We know we've got earnings come in so far. They're beating expectations. We know we have probably a 3/4 point hike coming on November 2nd. Of course, we have earnings coming up the week after that, I guess, and then they'll start talking about the December FOMC meeting. So we've got a lot of hurdles, but I do think we have about 2 to 3 weeks here where we could see the market and the different indexes kind of struggle and try to try to step higher a little bit as we navigate through the earnings and until we start to see the Fed get involved again, and then start looking at the December FOMC, and we get to the elections. I think when you have all those things hitting in about a 2 or 3 week period, it's going to be hard for the market to get above that. So at this stage, keep your eye on the semiconductor index. If that firms, that would be good for the whole market. But like I said, I do think we can probably inch higher here. Also, I've given you the URL for the CME FedWatch tool. Keep an eye on that. Like I said, yesterday it started to come down a little bit. Today we're at let's see, as I'm talking here. Today we're at about a 35% chance of a 50 basis point move in December, and 64%. So it inched up a little bit today on the 3/4 point. But if we start to see that get up for maybe where it's a 50-50 split on a 50 or a 3/4 point hike in December, I think that'll help prop up the equity markets also. So that's all I got for today, Will.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answer in the next Tuesday Tech Talk, email them to support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.